Assalamu alaikum. This is the first class of accounts in class 11, and we will start with a bit of a revision. And the topic that I've chosen for revision is the final accounts, income statement and balance sheet. The reason that I've chosen this topic is that there will be a few topics that we'll cover in this class where income statement and balance sheet will be included. For example, income statement and balance sheet will be there in the partnership, it will be there in the non-profit organizations, it will be there in the manufacturing accounts, etc. etc. So it's better if we revise income statement and balance sheet that we covered in the earlier classes. Moreover, I have chosen this topic because it will revise a lot of trifle small concepts that are coming in the accounts. For example, bad debts and provision for bad debts that we covered way earlier. End of the period adjustments will be revised thoroughly by doing this question, and some other topics will be covered as well. Depreciation will also be covered. So by doing this question, we will have a comprehensive revision not only of the earlier topics that we covered in the earlier classes, also of the formats of income statement and balance sheet, which will further be included in the partnership, accounts for non-profit organizations and manufacturing accounts as well. The question that we have in front of us is not a very difficult one, is not a very easy one. It's a mediocre question. Let's read out this question. The following balances were extracted from the books of Doji, a trader, on 30th September 2010. The following balances were extracted from the books of Doji, a trader, on 30th September 2010. Ordinary goods purchases, carriage inwards, revenue, sales returns, non-current fixed assets, motor vehicles, office equipment, provisions for depreciation on motor vehicles, depreciation on office equipment, provision for doubtful debts, salaries, rent and rates, discount received, sundry expenses, advertising, trade payables, creditors, trade receivables, debtors, opening inventory, that is on 1st October 2009, bank overdraft, capital and drawings. Let us talk about all the different items that are there in the book, in the question. First, we can see ordinary goods purchase, that is purchases. We have already seen this name, purchases. However, there is something different written over here, ordinary goods purchase. That means goods purchased in the ordinary course of the business, daily routine of the business. Those are the purchases that we make. Carriage inwards, we know where carriage inwards falls. Carriage inwards comes in the trading section of the income statement. It is included in the cost of goods sold, if we will remember that. It is a part of the cost of goods sold. We all know how to treat revenue, sales returns, non-current fixed assets are there, provisions are already given, provision for doubtful debts is also given, salaries, rent and rates, everything is there, we know, and there is nothing as such that we don't know how to treat it. Opening inventory is there, bank overdraft is there. That shows that bank balance is again not an asset, it's an overdraft. Let me revise what bank overdraft was. Bank overdraft is the amount that we withdraw from the bank more than what the balance was there in our account. Bank overdraft is the overdrawn amount that we overdraw from our bank account in excess of the bank balance that we already had. For example, if we had $20,000 and we finish those 20,000, we take those $20,000 out of the bank and we plan to draw further. The bank gives us a limit, and that is the bank overdraft. It's a short-term loan, if you remember that. Drawings are there. I don't think there is anything complex in this details of balances. Let's move on to the next slide and let us understand the few adjustments that are given in the question. Thank you. Yes, so now this is the question that is in front of us. The second slide, this question continues and it says additional information at 30th September 2010. I will read out and I will explain each and every single additional information to you all. Remember, I told you all that every adjustment falls at two places, comes twice in your income statement and balance sheet. Remember, I told you all. The first is inventory stock was valued at 14,600. This is the closing stock. Opening stock comes in the list of balances and the closing stock comes outside the list of balances as an adjustment. Closing inventory will come, it will be subtracted from the cost of goods sold 1 to arrive at the gross profit, and it will also come in the current assets as the closing inventory and in the current assets. So these are the two places that it will come into in your income statement and balance sheet. Second one, during the year Doji took goods costing $12.50 for his own use. No entries have been made in the books. These are the goods drawn. These are the drawings. Since goods are taken for the personal use, own use, this signifies drawings. Okay. Drawings can only be done by the owner. During the year Doji took goods costing $12.50 for his own use. No entries have been made in the books. The entry for this will be purchases credited and drawings debited. Means it will be subtracted from the purchases and it will be added to the drawings already given into the balance in the list of balances. These are the two places that it will come. I know you all have already studied this and you all have already done this in previous questions. I am doing this with you all just to revise it, because you people are coming straight from the holidays and from class 10 nothing is revised, so I'm just refreshing all those previous concepts. Third says advertising $300 was prepaid, salaries $2,600 were accrued. Now what is this? Prepaid advertisement, that is 300. Prepaid expense is the expense that is paid for the coming period. It is not a part of this period, so it has to be subtracted from the amount of advertising expense given in the list of balances, because this 300 is already included in the list of balances. Advertising that is given over there, list of balances. Since this 300 is not a part of the current expense, this has to be removed, this has to be subtracted, the working has to be shown in the income statement, and prepaid advertising 300 will also come in the current assets, in the balance sheet, in the current assets. These are the two places where prepaid advertisement will come. Now salaries. Salaries 2,600 were accrued. What does this mean now? That $2,600 for salaries was still being owed. $2,600 for salaries was still being owed, and that remained unpaid on 30th September 2010 on the last date. So this is an accrued expense that has to be included. It is not included in the expense that is shown in the list of balances. The expense for salaries that is shown in the list of balances, this is not included. 2,600 is not included. When this 2,600 is the current year expense, so this has to be included, right? What we'll do is we will add 2,600 in the salaries expense already shown in the list of balances. In the income statement we will add that, and another place where we'll record it is the current liabilities, that is salaries payable. So the two places it will come into is income statement. In the salaries portion it will be added, and in the current liabilities it will be written off as salaries payable. It will be included as a current liability as well. So these are the two places where it will come. Now point number 4 says depreciation is to be charged as follows. We have already come across both these methods, diminishing reducing balance and straight line method. I hope we all know how to treat them. Depreciation is to be charged as follows: motor vehicles at the rate of 25% per annum using the diminishing reducing balance method, office equipment at the rate of 10% per annum using the straight line method. We will apply this 25% on the net book value at the start of this year, and we will apply this 10% straight away on the cost. I'm not going into the details of these two methods. I hope and I believe that you all know these methods and you all know how to work them out. I've just given you all the hint that 25% will be applied on the net book value at the start of the year, and this 10% will be applied on the cost straight away. Now point number 5. Point 5 says trade receivables debtors include a debt of 4250 which is considered irrecoverable and is to be written off. Okay, one thing I forgot, going back to point number 4, I forgot to mention where are those two places where this depreciation will come. Depreciation will be recorded as an operating expense in the income statement, and that total depreciation up till now, till the end of this year, that is 30th September 2010, will be subtracted from the cost of the non-current or the fixed asset in the balance sheet. So these are the two places depreciation will be recorded. Okay, now going to point number 5, trade receivables debtors include a debt of 4250 which is considered irrecoverable and is to be written off. We all know how a bad debt is treated. We all know how a bad debt is treated. We all know how a bad debt is treated. Bad debt written off, the entry for that is income statement bad debt debit, accounts receivable credit. That means this 4250 debt will be shown as an expense in the operating expenses, and this will be subtracted from the amount of the accounts receivables in the balance sheet current asset. So these are the two places where this bad debt will be included. The provision for doubtful debts is to be maintained at 4% of all remaining debts. The provision for doubtful debts is to be maintained at 4% of all remaining debts. Now, I would like to remind you all what the treatment was for provision for doubtful debts. When we had to provide for doubtful debts, what we did was we made a provision. We used to debit income statement. And we credited provision for doubtful debts. Creating a provision. Okay. Similarly, over here we will debit the income statement and we will create a provision for doubtful debts. With what amount we will do that actually depends. In the list of balances, the debtors are given to you all. From the amount of debtors, 4250 has to be excluded, removed off, and then the remaining amount of debtors, we will apply 4% on that amount. On the remaining amount of debtors, we will apply the percentage of 4%, and then we will take out 4% of that remaining amount. Whatever the amount 4% of those remaining debtors comes, we will match that amount with the provision for doubtful debts amount given in the list of balances. I repeat, first we will subtract 4250. First we will subtract 4250 from the debtors that are given in the balance sheet, list of balances. Whatever the remaining amount for debtors is, we will apply 4% to that amount, and whatever the amount comes, we will match that amount with the provision for doubtful debts amount given in the list of balances. If there is an increase in both the amounts, if there is an increase in the 4% of the remaining debtors amount that we have taken out, we will record it as an expense in the income statement. And if there is a decrease in that amount that we have taken out as the 4% of the remaining amount, if there is a decrease in that, we will record as an income under the gross profit, and we'll add it to the gross profit. I hope everybody is understanding all this treatment, because we have already covered this in the previous classes, and I hope this should not be the problem. I repeat again, we will take out 4% of the remaining debtors after excluding 4250 from the list of balances debtors amount. Whatever that 4% comes on the remaining debtors, we will match that amount with the provision for doubtful debts amount given in the list of balances. If there is an increase, we will record it in the income statement as an operating expense. Only that increase we will record. And if there is a decrease, we will record it by adding it in the gross profit as an income. The next portion we will record it will be the balance sheet. We will subtract the entire provision from the debtors, so that will be the second place it will be recorded. So these are the two places the provision will be recorded. I hope everything is clear. And still yet, if somebody is confused in this, so please open up your registers of the previous classes and go through those lectures again. Bad debts and provision for bad debts, probably we have covered those in class 9. Coming on to the point number 6, on 1st of April 2010, Doji made a short-term loan 10,000 to the business. This was included in error in the capital account. Interest payable at 5% per annum has not been entered in the books. First of all, we must understand the date of the starting date and the ending date of the financial year of Doji's business. The year is ending on 30th September 2010, so it must have started on 1st of October 2009. So the financial year that Doji is trading off in this year is starting from 1st October 2009 and ending on 30th September 2010. Now the point to note is that Doji made a short-term loan on 1st of April 2010. That means from April to September 2010 there are probably 6 months. Let us count April, May, June, July, August, September. Yes, there are exactly 6 months from 1st April till 30th September 2010. Okay. So Doji made a short-term loan of 10,000 for those 6 months to the business, and this was wrongly treated as his capital. So first of all, we'll have to remove that amount from his capital account, and we'll have to record a loan. First, we'll have to remove that amount from Doji's capital account, and we'll have to record it, show it as a loan. Capital will be debited and loan will be credited. That means in the balance sheet, capital will be reduced by 10,000 and loan account will be shown as 10,000. These are the two adjustments that have to be made. Besides that, another point is given that interest payable at 5% per annum has not been entered in the books, and correctly so. Why? Because it was wrongly treated as his capital. Had it not been treated as his capital and properly as his loan, interest would have been shown. So we will show this interest now. Interest was not recorded at all. That means interest of 5% for the half year. Again, I am reminding it to you all. 5% is done for the full year. Whatever the amount for 5% of 10,000 comes, we'll have to divide it by 2, make it half, and then we'll record it as the interest payable. Okay. 5% of 10,000 is how much? 500. So 500, half of 500 will be 250. 250 has to be recorded for 6 months as an interest payable. Where we'll record that? We'll record that in operating expenses, number one, and we will record in the income statement, and we will record it also in the balance sheet in the current liabilities as interest payable. So these are the two places that will record interest adjustments. I have explained all these 6 adjustments. Now I hope everything is clear and this question will not be now difficult to do. For you all, prepare the income statement, trading and profit and loss accounts of Doji for the year ended 30th September 2010, and the balance sheet has to be prepared according to the format shown to you all for Doji at 30th September 2010. I hope you all have understood this question now. Please complete this question for the next class. This is your homework for the next class. This is your homework for the next class. Please, please, please. It'll do a world of good to your revision, that we will require from the next class. Please do this question for the next class. I will ask you all whether you all have done it or not. This is your homework for the next class. Thank you very much.